Hi everybody, I'm Steve McDonald and this is your Investors Daily Edge weekend wrap-up. This week the topic in focus is hard assets. As the markets worldwide get more and more volatile, and this doesn't look to be changing soon, hard assets are seen as a haven for investors who are looking for returns from investments that are backed by real assets. But first, the Sound Profit readers, I hope you had the opportunity to buy the stocks that I sent out on the rebuy list. Those are positions that we already have in our portfolio. We're adding to them on our fractional buy opportunities. And also oil. Please tell me you bought oil below 70. I know I've been banging the table about this for a long time, but this thing's going to bounce right back. And with oil in mind, here's a way to know when oil is fully priced. And believe me, we aren't close yet. Now, if you go back in your memory before the crisis period we're still working through, you may recall that when oil went up in price, stocks went down. That is the normal relationship between the cost of oil and the stock market. It reflects the fact that all businesses, all operations are dependent on oil, and as oil goes up, their cost of operations go up. This week, oil futures have been up as much as $2 a barrel in pre-market activity, which is a lot. I mean, $2 a barrel is ridiculous. And stock futures were up 200 points at the same time. This is not possible if the market senses oil is at or near a fully priced range. The sign to look for is when you see or hear that stocks are down because of oil prices have moved up. Then we know we're near the top for oil. My guess, $95 a barrel is the cry uncle area. There's a lot of money to be made between 73 or 74, where it is today, and 95. Next up, the flash crash. Most analysts are blaming the sell-off and the resulting drop in confidence in the markets on the huge monetary sell-off in the markets a few weeks ago that is now known as the flash crash. Most of the bullish sentiment in the market was driven underground by the possibility of yet another major snafu from Wall Street. The '87 crash was all computer-driven, and it seems we've made very little progress in preventing another one because of computer-driven trading. It's a reason to be concerned and another reason in support of tight trailing stops. They work. I know this sounds like another broken record, but you've got to get this point across. Okay, our guest today is Andy Gordon. Andy's the research director of Investors Daily Edge and a 25-year veteran of the markets and a graduate of the London School of Economics. He's here to talk about investment opportunities and hard assets, specifically copper. Welcome, Andy.
Thank you, Steve.
Why copper? Why now?
Well, we're in a global recovery, and you can argue the nuances of it, but I think the worst is over. And the global consumption of industrial metals is rising, specifically copper. And just as importantly, production of industrial metals is lagging. And again, specifically copper. Put the two together, and copper looks pretty good these days.
So what's going to drive the price? Who's going to drive the price?
Asia.
Gee, I'm so surprised to hear that.
Fast-growing Asia is going to drive the price. Asia accounts for 57% of global demand, and imports are on the rise. For the first quarter of this year, imports of copper rose 18%. That's very bullish.
Okay, now, do you see demand ramping up rapidly? Is this a slow thing? I mean, what are we looking at in terms of consumption?
We're looking at fairly strong consumption for this year, basically because China is having trouble cooling down its economy, but it is tapping on the brakes. Copper fabrication started to pick up in China during the second half of last year, and it's been going up ever since. China imported 63% more copper in '09 than the year before. And more recently, the last month we have numbers for is March, and its copper imports were up 42% in March over the previous March. So copper is in very, very robust demand in China, and I don't expect that to change.
Now, we record this Thursday afternoon. I don't know what happened in the market Fridays, obviously, but just the mention from China that they still had confidence in the EU and the market went crazy. That's really what drove it Thursday.
That's right.
But what happens if the EU blows up? There's a lot of people saying that they haven't really solved any problems.
Well, that's right, and there's a lot of truth to that. Basically, what we're going to see is a sequel. We've already been through this before in 2009. 2009, outside of China, copper demand went down 18%. In China itself, copper demand rose 43%. So what happened is that China supported global demand. It was still robust. It still maintained tight supply. So I think at the worst, we could see this in what happened in '09 as copper prices went up.
Yeah.
Went up a lot, more or less doubled.
Yeah.
Yeah.
What industry should our people be focusing on that are going to drive this?
Well, the obvious industry is, the electric grids, the copper wiring required for electric grids. I don't want to keep going back to China, but I'll tell you, it's a big country. One Chinese utility last year used enough copper wire, basically was the equivalent to what the UK uses in its entire electric grid. So this is what this one Chinese utility adds to its grid every year. So that's the obvious thing. But if you look at other industries like auto, and I think you've talked about how strong the auto industry is in China, and globally it's rebounding too. And there's a lot of copper that goes into cars, 50 pounds for, just for your garden variety car that we drive. But when you go into hybrids, it doubles from 50 to 100 pounds. And then when you get into electric cars, and this is the next generation, it goes from 100 pounds to 200 pounds of copper for every electric car. So you see the combination of the global auto rebound, the autos being very, very strongly in demand in China, and the fact that the new generation of cars require double, thrice the copper as the previous generation cars. It's very, very bullish for copper.
Great. Thanks so much for being with us.
My pleasure, Steve.
That's about it, except, the Slap in the Face Award. I know, that's why you folks really watch this, don't you? This week, the press and media gets the award for blaming Obama for the oil spill problems in the Gulf. Now, you all know I'm no fan of the president, but what does he have to do with BP's oil spill? Can the press really think that a bunch of Washington politicians can really do a better job in an oil spill emergency than the oil industry? This is ridiculous. Now, that's a quick and dirty one this week. Could Mr. Obama perhaps be getting a little taste of the treatment Bush got from the press? Oh my, what will the press think of next? What do you think?
I think he's getting a taste, Steve.
I think he's getting a taste.
Yep.
That's about it. Have a great holiday weekend. We'll see you Wednesday in the next video. Thanks so much.